We've got a great discussion for you, great set of panelists here. It's obviously going to be very interesting back half of 2024 as folks gear up for this fundraising environment. So excited to have a group of veteran CFOs, experienced capital market executives, venture bankers pulled together to talk through some of this. So I'm going to hand it off to our moderator for today's discussion, Benjamin Friedman, to get us teed off. Before I do so, a couple of housekeeping items. Please keep note that today's session will be recorded. We'll be sending this out for everybody afterwards. Everyone's lines have been placed on mute just to prevent any background noise. If you'd like to turn off the closed captioning feature, you can click the live transcript button on the Zoom bar below. The chat feature has also been disabled, as some folks were mentioning. You can submit your questions through the Q&A button. And as mentioned, we're going to be sending out both this webinar as well as contact information for the panelists and a bunch of additional resources once we wrap. So without further ado, Benjamin, I will hand the mic over to you.
Great. Thanks, Jake. And welcome to our panel discussion. I'm thrilled to have everyone here today. My name is Benjamin. I'll be moderating. I want to briefly share my background. For those of you who are new to Graphite, we're a fully sourced finance and accounting service for early stage VC-backed companies. Personally, I'm a former 4-time client. So before I joined, I was on that side. Then I went to the team back in 2019 to focus on client success. And in talking with clients, I would hear again and again the phrase, "I don't know what I don't know." And I appreciate that everyone joining this call, you're impressive because on the one hand, you're trying to accomplish something amazing. And on the other hand, you're trying to plan effectively while facing an uncertain environment. The FinTech landscape and funding continue to evolve, presenting unprecedented challenges and remarkable opportunities. And while we can't predict the future, even in the next hour, we can certainly prepare for it by learning from those who've successfully navigated similar paths. So I encourage you to ask questions and to think critically about how their insights will apply to your journey. And now I want to introduce Jeff.
Hello, my name is Jeff Zinn. Glad to be here. Thank you to the SVB and Graphite partners. Derek Watson and I co-founded Scalepoint Advisors to help early stage companies scale. We provide a set of services, including financial leadership, CFO, capital markets, and business development to early stage companies. That is our passion. My background is roughly 30 years, split between 20 years on Wall Street, working with early stage companies directly, working for and at early stage companies, and investing in early stage companies. And I look forward to the discussion and look forward to meeting many of you and seeing how we at Scalepoint, SVB, and Graphite may be able to help you scale and grow your business. So thank you for attending today.
Right. We can go to Derek next.
Oh, me next. So, hi guys. So Derek Watson here. I run the CFO practice at Scalepoint Advisors. As Jeff mentioned, we work mainly with seed to B fintechs, and it's for those folks that don't need a full-time CFO, but do need CFO level, inputs onto in their team. That strategic level support, help them go from A to B. My background, I'm from Scotland originally, maybe tell that by now. I started off with PricewaterhouseCoopers, was with them for a long time, worked internationally with them, wound up in Seattle, where I am today. I joined Amazon in Luxembourg, the European headquarters, and found my way to Seattle. Got into startups in 2019. I joined Resolve. They're going great. I was running finance, risk, and ops there. And during COVID, started to do fractional CFO work on the side. Found I really loved it. So combined my fintech experience and my finance background to partner with Jeff and launch Scalepoint Advisors. Happy to be here today. We're great partners with SVB and Graphite.
And Chris?
I think Chris is next, yeah.
Super. Good morning, everybody. Chris Mossa, I'm Chief Strategy Officer here at Graphite Financial. I was formerly the CFO of a FinTech company in New York City, a company called Advisor, which was a wealth management technology platform. I was there for a number of years. We sold that business to Orion, which is a large portfolio management software platform in that space in 2019. I stayed for a bit, left, and started a practice basically to kind of fix all the things that I thought were broken in startup finance, having gone through that experience myself. And we scaled that business, fully fractional finance department, everything from CFO down to transactional accounting for the next couple of years. Grew that to about 50 early stage VC-backed companies, and then folded that into Graphite Financial about 18 months ago. And so I joined the team here, and now the team here at Graphite, myself, the former folks from my shop, we're building, really a best-in-class fractional finance practice that covers all the things a traditional internal finance department would do, but on an as-needed basis. And so really excited to be part of the panel today. Spent a lot of time talking to early-stage founders and what their concerns are. So looking forward to the discussion.
Thanks, Chris. We're going to start off with a broad question that'll set the tone. And Jake, I want to begin with you. How has fundraising changed for fintech startups this year?
Great question, Benjamin. And maybe I'll contextualize that with just the where I sit within SVB and gives you a sense of the data that we're looking at. So I sit within a startup banking practice, which typically works with companies from articles of incorporation, idea on a napkin, nothing else built, up through kind of a Series A inflection point where companies are kind of graduating out, starting to need much more sophisticated services. Maybe it's debt, maybe it's payments capabilities, things like warehousing. I'm sure we'll get into it. And so one of the beauties of being SVB and getting to work with the majority of venture-backed companies and the majority of funds and sitting at that intersection is the volume of transactions that we get to see in some of the internal data. And so maybe to set the macro stage here, I think there's two big trends that are impacting fintechs as it relates to fundraising, whether it's for debt or for equity. One, on the equity side, we're definitely seeing a Series A crunch right now, right? A lot of companies that went out and raised during the hype cycles of 21 and 22 that are now maybe not achieving the metrics that the market is demanding. And we've got fewer funds that are out there that have been able to raise fresh vehicles to turn around and actually deploy that capital. So you've got a really crowded market while you've got folks that are coming out that have raised a ton of money at high valuations and fewer folks on the other side of the table to be able to fund them. That's impacting folks across all sectors. When you layer in on top of that, some of the regulatory focus on fintechs today, especially those is what we call deep fintechs, right? If you're moving money, if you're lending money, if you're holding customer funds, there's a big question of how much appetite there's going to be from large financial institutions around partnerships with these fintech businesses. And so there's a bigger question on go-to-market and metrics for these folks. And so when you layer in a Series A crunch at a macro level and specific scrutiny, regulatory scrutiny as it relates to fintechs, it's going to be choppy waters for folks that aren't really well prepared to go out and run a capital markets process.
Thanks, Jake. Jeff, you want to chime in next?
Jake said a lot of important things. I think the bar has certainly been raised. At the same time, there's some wonderful ideas out there and some really seasoned, great founders doing wonderful things. I think that all the three pillars of a venture pitch obviously are TAM, product, and team. What we're experiencing is investors are a little more reticent to plow right in and really want to see an understanding of burn, pathway to break even, and a deep understanding of unit economics on the part of the founders. So helping founders understand these things about the business, optimize them, and most importantly, articulate and execute on them is something that we spend a lot of time and focus on. And when we can get it right, clients get money, and that there's nothing more pleasing than to see a successful fundraise happen. So
Nice. That makes sense. Chris, what would you like to add to that?
Yeah, I think the thing that really resonated with me when Jake was talking was about the shift in metrics, right? And the metrics that used to get a deal done versus where companies are finding themselves. I would say over the last, and I know this the kind of bracketing on this panel is this year, but I would say even going back maybe 12 to 15 months, when we really first started seeing that shift, is the goalpost changed, right? So companies were able to fundraise on much lower bogeys than they can now in terms of the key metrics in the space. And that could be, across different business models. I'll use a SaaS model just for explanatory purposes, but, an ARR number and a churn metric that might have gotten a deal done in Q1 of 2023 is not getting that same deal done now, because the bar's just been raised. And we're seeing that over and over again. The downstream impact of that is, some companies have been, I won't say caught flat-footed, because they were, conditioned to expect a certain thing in the fundraising space, but they've had to pivot. And we've seen many more inside rounds and bridge rounds in the last 12 to 15 months than I ever saw before, because insiders are still around the table. They're still coming together to support founders and to support companies. But the big kind of flashier rounds with new capital coming in, we've seen less and less of that. And so, thinking about that and positioning the company, positioning the story for an inside round maybe versus an external round is a bit different. And so we've been, helping clients a lot with that shift, I would say, in the last 12 to 15 months.
And Chris, I'll add to that point quickly, because I think the metrics piece is really important, because it can change so dramatically just over the course of a couple quarters. And so for folks that are trying to understand metrics and where things are at with the market right now, we'll share this after the session, but SVB just released our State of the Markets report, which actually dives into what we're seeing from a metric standpoint. But metrics are half the battle. Understanding the narrative around the metrics is just as important. And that's why working with folks that have gone through this capital markets process, folks like Derek and Jeff and Chris and Benjamin, are so useful when you think about contextualizing your metrics with an important narrative that's going to carry you through any kind of capital markets process.
I agree.
Thanks, Jake, and appreciate that, Chris. Derek, how do you want to anchor this question?
Yeah, I think the fundamentals are still unchanged, right? In the sense that, VCs will be looking at, is this the right team? Do they believe there's an opportunity there? That's sort of earlier stage, going through, product market fit and signals of that. And then beyond that, looking at signals that, that you can grow virally or exponentially or whatever is needed there. So that is the same as it's always been, but the bar is, I think, higher now. Like, the capital is still available. It's just kind of, there's more like a flight to quality, right? In the past, maybe charisma and a great story could have been enough, but that's not enough now. It's charisma and a great story and, proof points in your numbers, and credibility on what those numbers look like and how they're going to evolve, right? So I think getting on top of your unit economics, having that, buttoned up in terms of anticipating the type of questions that you're going to get, have the answers ready, be able to talk about that in a way that's credible, right? Your CAC might not be ideal today, but it's going to get better because of XYZ reasons. LTV might be this, but it's going to get better because of XYZ. And being able to have those prepped and be credible, I think, is more important than it's ever been, or at least, in recent years.
Yeah, that makes a lot of sense. And I think you helped me out as well in segueing to the next question. I'd like to talk with Chris and you about fundraising, and specifically, how do you know when you're ready to raise a Series A or a Series B? And if you are ready, what do you need to do in order to prepare for one of those eventualities? Chris, if we could start with you, and then Derek will come right back.
There's two answers, really. The first and most simple answer of how do you know is you're running out of money, right? Or you have a pathway to running out of money, and something's got to happen, right? And that could be 6 months, it could be 9 months. The best companies that we work with know what their, what they call their fume date or their sort of money out date 12 months out, right? Because they've got a really good forecasting function and they've got a beat on that. I would say, the other path is maybe you're running out of money or you're not, but you've hit a certain metric level, or you've hit a stride in the market, in terms of product market fit, in terms of you've identified an ICP that's working for you, and you want to put more capital behind that, and there's a really good story to tell about the product with that ICP. And when those things come together, and you've lined up the team that can tell that story, I think back to Derek's thoughts a minute ago on being able to tell that story in a comprehensive way that lands with an investor, right? But when those things happen, the balance sheet is the second part of the story, right? And you may be running out of money, you may not be, but it doesn't matter, because once you can do that, once you can package those things, and you've seen that success in the ICP with the product, you're delighting a basket of customers. That's the time to kind of step back and say, let's put some packaging around this, and let's go see what the market thinks about this. And if there's some capital we can put behind it, so we can just do more of it.
Great, great. And Derek, what are your thoughts there?
Yeah, I agree with all of that. I think, key to it is being super on top of your cash flow projections, right? And what we see at Scalepoint, because we do have a fintech focus and we work with a lot of lending businesses, is it can actually be quite tricky to forecast out your cash flows if you've got, balance sheet nuances, right? You're borrowing at a certain advance rate. It can be tricky to map out your cash flows as you grow. So being really tight on that and understanding, if I pull this lever, what's that going to do to my cash flows? It's, we all can do easy things like, if I hire X or Y position, what does that do for my cash flow? That's the basics. But in a lot of fintechs, lending-based fintechs in particular, you have to go a level deeper and be like, well, if I increase my volumes by this much, what's that going to do for my AR, for my borrowing, for my related cash flows? So being really tight on that. And then, Chris said, 12 months out, I think, you're looking at, between 6 to 12 months. If that's your fume date, then, T minus 12 months, you should have exploratory conversations. T minus 9 months, you should be making good progress. And, T minus 6 months, you want that raise done, right? And I'd also echo just points about readiness. Obviously, it's stage appropriate. Again, I think for your Series A, it's, in my mind, it's a lot more about strong product market fit signals. Is there demand what you have pulled together? And do I believe as an investor that there's going to, in the next phase post Series A, that you can grow it? Looking at your B, then it's much more about, okay, your product is kind of settled. Do I believe that if we pour more fuel on the fire, you're going to be able to grow it, 3x for 3 years, etc. So it's stage appropriate. And like I said in my earlier comments, that's fundamentally not changed in this environment. It's just the bar is higher.
I really appreciate you getting into specifics there, Derek. For everyone attending, a reminder that we are taking questions. I plan to send some more over to the panel for the next 15, 20 minutes or so. And then I'm going to pull in your questions and ask the panel. So feel free to ask those in the Q&A section. Chris, I have another question for you here. How do you go to market with a capital raise?
Yeah, I mean, I think so. We've started at the beginning, which is great, which is knowing when you need to go to market, right? So that's the first step. So what that requires is having, a really tight forecasting process inside the company. So you have that time frame. Derek's point about being ready months before that, right, and building in enough cushion is key. But once you've decided that, hey, it's time or it will be time soon, how do you do it? You really, at the Series A level, you can get away with a lot of things at the seed level. At the Series A level, it's really about professionalizing the thing that you're going to put forward, right? And so that's everything from, if you've been on cash basis accounting or light accrual accounting, really sort of moving up the food chain there and going tight accrual based accounting, right? So just to talk very, very clear specifics. If that's not in place, it's tough to raise on that without that. Understanding unit economics and metrics. How much do you keep from every dollar that a customer pays you? If you can't answer that question, that's sort of block and tackling, right? So building the systems and the reporting methodologies in place to capture that data and regularly and reliably push that to an internal management team, push that to a board of directors, push that to an investor in the context of a pitch. That's really key. But that requires a sort of systems understanding of where data sits in the company. Some data might sit in a CRM, it might sit in a billing system, it might sit in a subscription management platform, it might sit on the back end of the product, the platform that you're selling, it might sit in the accounting system. Having a comprehensive view on where your data sits, bringing it into a centralized place, and then really, drilling down on the metrics that are going to matter and help tell that story, getting that together and working those reps before you have to, right? So work them internally, build the reporting that you want to sell to an investor and sell it to your management team, then sell it to your board. Do all of that and get all of that right. Get those reps under your belt before you're going to go out to an outside party who's going to be less forgiving if something's missing, right? Or something's not done how the market expects it to be done. Get the reps under your belt. And all of that comes back to walking back the clock and understanding exactly when you're going to be in those conversations so you can build in the practice time. You can build in the system development time. You can build in the metric development. You can decide who's going to be out there telling the story. But knowing that, managing the calendar is where we see companies have the most success when they get in front of that.
Yeah. And I just want to add to Chris's point, because we sit on the other side of this as companies that are coming in, especially as it relates to any kind of more structured products. You start thinking about things like warehouse, et cetera. The metrics are not enough, right? Being able to trust the metrics and knowing that when we get into a situation, you're going to be able to do the reporting and the reconciliation in a timely manner, and we can trust that data, is just as important. And there have been plenty of situations where companies definitely had the metrics to meet our bar where we think about our entry point, but we just couldn't trust the quality of the data as we started to get in and pull on certain threads. And those are the deals we're never going to do, right? I would much prefer to work with a team that maybe is a little short on the metrics and trending in the right direction, but is highly disciplined on the way they collect and report that data, 10 times out of 10. So really, really important point, Chris.
Chris, I really appreciate your answer there. And Jake, your additional detail, that's really helpful. Jeff, I know you've had a chance to warm up, so I'm going to start you off on this next question. How should we think about the relationship between equity and debt capital?
Well, it's a great question. So the first way I think about it is when we say debt capital, we need to divide it into two categories: venture debt, which is oftentimes a bridge between rounds, and actual lending capital that we consume in a finance business. We happen to be in a period of time right now where there's, and I don't want to jinx this, but there seems to be an ample amount of lending capital that's been raised. It's hard to pick up the newspaper without reading about private credit. So for lending companies, there's a great deal of debt capital out there. I think the more challenging part of the equation right now is sourcing the equity capital and the required amount of equity capital to support a lending facility. And we see this all the time with companies. They've got great metrics, but they struggle oftentimes to get a corpus of equity capital to both support operations and then support the needs of the lending facility. And these create decisions that are very impactful and consequential for the business, because oftentimes you have to take what works. You have to take the solution that drives the company forward, and there's oftentimes trade-offs. We have a saying at Scalepoint that there's no wrong answers, there's only consequence. We help you look into the consequence and understand that, particularly when we're helping you choose a lending facility or working with a lending partner. So that's sort of the debt, and in particular the lending debt part of this. Equity is a much different sort of sales process and process, because in debt, your debt provider wants to know they're going to get their money back with their coupon. Equity, they're looking for a much greater return, and oftentimes the two things are, guess what? at odds with each other. So with equity, one thing we like to do is look down the road a little bit and understand where a business needs to be to go back to market. What metrics are important for the business? What comps are there in the business? But a lot of the things we've covered already in this conversation, burn, cash utilization, discipline around data, expense management, and real knowledge of the business and the market dynamics and the industrial logic are very, very important to making the difference in equity. And again, it's the audience too. Bringing your company to the right set of potential investors is so critical. We've talked a lot during this call about the venture capital market. There's a whole other market of strategic partners and corporate venture capitalists that want to look at these businesses too. And in many cases, this period of time is offering these investors an opportunity to invest in great companies that they wouldn't have seen in prior venture cycles. So there's a lot there, but I hope I covered the high points of it.
I think you did. You covered a lot. I also know Jake knows a thing or two here, so I'd love to hear his thoughts.
Yeah, no, I think Jeff hit the nail on the head. And so maybe I'll tease out a couple more themes that he mentioned. One, there's an interplay, right, between equity and debt. And so to Jeff's point of thinking about, we use this internal terminology of what we call investor dependent debt. So generally, as we're thinking about venture debt, so we'll cover that topic, versus something that is much more structured. It's underwritten to, cash flow, balance sheet, assets, things of that nature, right? We're much more sensitive to the metrics, right? But if you think about traditional venture debt, as Jeff said, sometimes this is almost like a pre-negotiated bridge round, if you will. Number one, the best time to have any conversation with a lender is the minute you close on your equity dollars. You're in the strongest cash position, you've got momentum behind you. And frankly, from just like, founders don't like creating duplicative work. A lot of the materials that you've pulled together for that equity fundraise are going to be applicable for a venture debt process as well. And so our recommendation is, the minute that you close on that equity round, and in some cases where you've got a term sheet and even have line of sight into where that round is going to end up landing, that's where we like to start our underwriting process. Sometimes that actually gives leverage to founders in closing out that equity round when they've got, contingent on that round coming together, terms from a player like SVB, that gives them more leverage when when it comes to kind of their equity negotiations. But that's the best time to start that conversation. And if you think about it, effectively what we're underwriting to for a traditionally venture-backed business, you close a Series A, we're going to layer in venture debt alongside that round. If you're still a cash burning business, which is almost always the case, what we're underwriting to is what it's going to take for you to get to your Series B, right? And so, of course, it's the management team. Of course, that's the narrative. Of course, it's the metrics. But equally important, to Jeff's point around the types of investors that are around the table, we're looking at that cap table and that syndicate. We're picking up the phone. We're calling your lead investor, understanding how they got to conviction on the business, what they're doing from a reserve standpoint, where they're at in their fundraising cycle. Could they participate in an inside round if things go sideways? Because effectively, we're underwriting to, can these insiders make sure this business gets to those milestones to participate in that Series B. And so from our point of view, when you're working with equity investors that have a long track record, that have traditional incentives, GP, LP structure, that becomes much easier to underwrite to with traditional venture debt versus lots of other wonderful ways that companies can capitalize, strategics, high net worths, angels, et cetera. But they tend to have different return profiles and expectations, and especially with strategics, different things that they're optimizing for, which can make it more challenging for a traditional venture debt lender to understand kind of their trajectory and their requirements for participating in kind of inside rounds. So just important to understand that from a venture debt point of view, beyond just the story, the makeup of your cap table is equally important to us. And that's why when you work with lenders that have a long history of working in this ecosystem, most of the time, the VCs that are taking a board seat have worked either with us or others before. Definitely get their opinion. You need to have board buy-in before you're going to go out and start that process. So maybe a little bit more tactical flavor to add to Jeff's point there, but happy to take any follow-up questions for Benjamin if we get them from the audience.
Yeah, I actually have, Jake, I'd like to send something back to you because one thing that I find a lot of our clients aren't aware of when they think about venture debt is they think they don't necessarily need the capital. right after a raise. They think it's like, oh, it's all outstanding on day one.
Yeah.
Can you talk just a little bit about the value of having that cushion without having to pull on it, right? Either as a
Great
rainy day fund or as a way to catalyze growth at some point in the future, but getting it shored up at that time does not necessarily mean you got to grab the line or you got to pull
Great question.
funds off.
So 2 points on that, Chris. One, you can get a term sheet, you don't have to take it, right? So at a minimum, you've done all the legwork to like go out and put together these materials to raise your equity round. You may as well, especially if you're working with a seasoned finance team or have outsourced CFO help, have them run you through that process so you know what your options are. But to your point, Chris, the way that we think about structuring venture debt, and obviously this changes based on, all the disclaimers, changes based on the company profile, et cetera. But generally, this is going to be an extension of that equity round. Our sizing is typically 20 to 30% of that most recent equity round size in terms of our commitment size. And we're going to build in an interest-only period. And so it might be 18 months of IO, which means if you're not drawing down on that facility, you're effectively not paying for it. And so for most companies, they burn through those equity dollars. They get to their 6-month cash out date where they would be from equity dollars, which is oftentimes where companies are starting that fundraising process. And in this environment, maybe a little bit late in starting that process. Because they've got that venture debt facility, it's an option that they can draw down on to effectively extend out another quarter, 2 or 3 to go out and hit those metrics to raise that next round. It works great for companies that are on a tear and just want to put some more fuel on the fire before going out to try to raise their valuation. And it works great for companies that maybe there's a big macro change, maybe a big customer turns off, but you've got effectively a safety net, a pre-negotiated bridge round at attractive terms, instead of then having to go out and scramble and taking really expensive debt from hard money lenders. I don't know if that answers the question, Chris, but that's how I think about it.
Yeah, it does. I mean, it effectively pulls you off the 24-month cycle, right? The standard cycles I'm going to raise, it's going to buy me 18 to 24 months of capital until my next raise. Well, if I can go out and do another 6 or 12 months on the debt, on the back of the debt line, right? I can still push that out a little bit while I'm chasing that sort of, last leg or that last mile of metric development, or if I'm close and I don't necessarily want to entertain, say, the valuation that I might get today if I know I'm close in 6 months. It gives me that breathing space. That's at least I hope that's right, because that's the message we've been telling our clients on why they should do this immediately after raising an equity round.
Yeah. And what we actually see a lot of companies do is, they get, they raise at Series A, they put the venture debt in place, they then go out, they're at that go, no go round. They go out and they raise a Series B from a position of strength because they have more room with that option. And then they refinance the facility and that clock restarts itself. We put a new IO period and we kind of kick that can down the road. So a lot of companies are putting this in place, never end up using it, but it helps them manage dilution and gives them that safety cushion as well as they go after the process.
Yeah, it's almost akin to like an insurance policy.
It's a great way to
more
think
so
about
than a financing vehicle.
It's a great way to think about it.
Right. Absolutely. Good points.
I do have a couple more questions, but I see a few questions have come in from the audience, and I think it's time to shift gears here. So I'm going to read out the first question, and then whoever is eager to answer it can jump right in. Jacob Zaks, if I'm pronouncing your name correctly, he asks, what do you think about consumer versus B2B fintech?
What do we think about it? I'm a big believer in having a well-defined channel and a well-defined way of reaching your ultimate customer. B2B, if done well, it really contain a lot of that CAC spend and have it greater line of sight to a specific audience, a specific persona with a specific CAC associated with it. So, I tend to find those businesses a bit easier to model from a client acquisition standpoint. If we're talking about underwriting, consumers tend to be easier to underwrite than businesses. So it really depends on where in the flow chart you want to look. Derek and I both have experience with small business lenders up close and personal from working at them. So Derek, I don't know if you've got a specific thought on that, building on my comments.
Yeah, I think you're right there, Jeff. I was actually looking ahead to the next question in the Q&A, kind of formulating a response to that. But I think you're spot on and nothing to add.
Hope that
I
was
think-
helpful.
Well, one thing that's been interesting from our point of view is like, obviously when you're doing anything that is going direct to consumer, right, there's an additional layer of regulatory scrutiny, right?
Right.
When you're dealing with, B2B transactions in general, it's less forgiving. The expectation is counterparties tend to be more experienced, more professional. And so on the B2B side, you need to have a really well articulated path to market that considers all of the changes in the regulatory environment. And it's also interesting as we think about the makeup of founding teams. I found oftentimes folks building in the B2C fintech space more than often versus the B2B space actually come from outside of financial services, right? And so that's usually like a flag to dig into. You're coming from outside of financial services, you're building a financial service for a consumer directly. Do you understand the minefield that you just waded into? If not, make sure you've got folks around the table that can help you navigate those pieces. I think that's really, really important in this environment.
That's a good point. That's a good point. And the other thing is, the number of personas that you're going to run into in the consumer space sometimes is much more varied than what you get in the small business space or the business lending space. So you've got to be prepared and anticipatory about that in your selection of lending facility and a whole bunch of things. But really understanding kind of who can possibly walk in the door asking for your services is an important part of all of this, particularly when it comes to finding a lending facility, because you're going to have a variety of types of borrowers come through. So I think it's important to kind of really think about not just what you see today, but what you might see as you scale.
Bridging it back to the financing of that business, right? You better be prepared to raise more money in the consumer space, because it's going to just cost you a whole bunch more money to acquire customers. So all else being equal,
That's right.
Prep for a bigger raise, be able to tell that story that on a bigger raise, but know that your go-to-market spend is definitely going to be several multiples probably of what it would be in the enterprise space.
Chris, maybe it's a follow-up question, both for you and then also for our friends at Scalepoint. What are you seeing in terms of like companies going out, raising a traditional Series A? How many months of runway are companies looking for in today's, or actually maybe more interesting for seed, given the Series A crunch that we're seeing right now? How much more runway are companies raising today? Has it changed versus the conversations you guys have been having, call it 24 months ago?
Yeah, so for a formal priced A, it's changed, right? The standard used to be kind of 18 to 24, right? I want to make sure that you can live for a year and a half to 2 years until you have to raise again. I think 24 months is now the floor for a priced A, right? 24 is the floor. It's really in kind of 30 to 36, maybe at I don't want to say the ceiling, because maybe profitability is the ceiling. You never have to raise again. That's a great story to tell, but maybe that's kind of the higher end of that range. So that has shifted up. For the bridge rounds and the non-priced rounds, the safe rounds, which is, like I said earlier, what we've seen just, much more volume around, because that's kind of where insiders tend to sort of put those bridge lines in place. It's more flexible because it is friendlier. It is about supporting the company versus doing a big growth round. And so I would say those are all over the map. It's almost never less than a year though, right? It's very hard to finance a company if you can't demonstrate that you're not going to have to go back out before another year. But on the price days, I would say it definitely has, 24 months is now the floor.
Yeah, I'd agree with that.
Great. I want to get to our second question. And Derek, I know you already have your hand up. If you've just launched a product and have strong product market fit signals, but minimum AUM, are projections enough? And this was anonymous. If you want to claim the question, feel free. But Derek, definitely wants you to answer it.
Okay, yeah, I'm interpreting AUM as assets under management, and then therefore looking at this as a question rooted in a lending type of business. I think at the highest level, are projections enough? Well, they might be enough for someone, but are the terms that you're going to get attractive enough to you, right? It's going to be too expensive. Maybe the covenants are really restrictive. Unfortunately, we do see at Scalepoint clients come to us with lending businesses where, their first or second credit facility, sounded great at the time, but now has them in kind of a straitjacket. and they're strategically stuck in terms of what they can do, either product flexibility or growth trajectory. So not all term sheets are necessarily the right one for you, right? So be very mindful about that. There's comment that Jeff made earlier on about the personas, the debt provider persona. And I'm not talking about venture debt. I'm talking about the lending capital and the equity persona, right? The debt persona, it's much more about the brass tacks and the financials. Their risk return calculus is I'm deploying capital, getting a coupon, I'm going to get my capital back. The equity investor knows that in this game, you may lose the capital. So different calculus, much more focused on the numbers. And with that come restrictions that come through in the covenants, etc. So that can impact the quality of a term sheet. So our projections enough? They may well be, but it just depends on what kind of term sheet that you're going to get. The second part to this, or another way I'd think about this, is what exactly is the root cause of the minimal AUM, right? I'm guessing if there is product market fit, then it must mean there's some resource constraint elsewhere, which maybe you don't have enough equity to put, to fund the AUM, or you have insufficient debt capital to fund that AUM, right? And we see this a lot where businesses maybe didn't raise enough in the seed round to be able to even hit the metrics that they're going to need in the A round, right? Like if you do too small a seed, you're gonna, you've got your classic investment in product and marketing and the team, etc. But you need to leave some of that some of that's going to get locked up into working capital. And the amount that you lock up in working capital to grow the business may be insufficient to hit the metrics for a Series A. So there's a little bit of a chicken and egg problem there. So I'd say if you're in a lending type fintech, your seed round, in dollar terms, maybe you should think about making it a little larger and earmark some of that money for going into for working capital use and not for burn. Yeah.
Yeah, let me. I think that's very good advice, and I agree with all of it. I would say that going to the questions, strong product market fit signals are important, but I would recommend that one kind of double clicks on those signals and sort of proves how robust that data is. The more robust it is, the more usable it is. So not all data, not all signals are created equal. A pending contract from a partner, et cetera, another channel that could be open with a certain amount of capital raise. Those are very high, strong proof signals that an investor would want to see. So I think really the quality of that data is very important. And then I just want to touch on one other thing that Derek said. I think it's important, and no one likes to do this, but there's the plan, and then there's the other plan. And I think operators in this environment really need to kind of understand what's your plan B, what's your escape route, what can be cut, what can be moved, fractionalized, et cetera, in a business to extend runway. So what are the levers to extend runway in all of these businesses, and how do they work, and what's the impact on the business? And just be thoughtful about that. Going in with an understanding of where the business needs to be at a certain point in time to raise the next round is critical. And then figuring out the different paths to get there is oftentimes the difference between getting there and, quite honestly, not getting there. So all these things are, require careful consideration. Again, no exact wrong answer, just a lot of consequences that operators are left dealing with depending on the answer.
Yeah. I want to add maybe two quick points to Jeff's point there. One, he talked about kind of the plan A, plan B. There's also a plan C that's really important. Let's just remember that we're talking about folks offering financial services here. And so recognizing when your cash out date is that you have enough runway to effectively wind down the company, if that's the direction things are going. It's different in this ecosystem and in this sector than it is in other ones, right? When you're dealing with people's money at the end of the day, you need to be cognizant of that and all the considerations that come with that, right? So I think that's an important point and something that we actually look for in evaluating companies, again, those that are moving money, lending money, holding customer deposits, like have they thought through what that cash out date looks like? Because it's a different calculus than for other startups. One other point that I think Derek made, and it's a tactical one, but it's important when you're thinking about who your counterparties are, especially on the debt side. Bank debt, for example, is very different from debt fund debt. And usually the way that manifests itself in that our cost of capital is dramatically lower than a fund that has to go out and raise external capital from LPs and then provide a return. The flexibility that funds have in terms of size and entry point and structure is significant in comparison to a bank, right? And so understanding who you're talking to based on what it is the product is that you're optimizing for or where your narrative lays is really important. If you are, for example, looking for an early warehouse or an early lending facility, you're pre-origination, you're selling the story, it's really hard to get a bank comfortable with that. We're used to seeing, $7 million plus in originations and 18 months plus of loan tape, et cetera. So think about the counterparties based on where you're at in the journey, because you can always make those changes down the road. But to Derek's point, if you're going to take a term sheet, especially from a lender that doesn't have a track record of participating in this space, get an outside point of view. Make sure you don't take a term sheet that turns into a straitjacket. We've seen tons of scenarios where folks come to us because they want to upsize their warehouse. And because of the hooks that are in that early facility, it makes it really difficult for the business to do so. And so bringing in folks like Scalepoint and Graphite and others can help you evaluate that with call it a no bias point of view.
There's been a lot of fantastic information here. I want to do a gut check. We have about 10 minutes and we do have 4 more questions. So I'm going to ask for each of the remaining questions. Maybe if one person can chime in and give their thoughts. And then if we have a couple minutes at the end, maybe somebody else can. But I do want to touch on each one if that's possible. So Andres Delgado asks, what is the range a VC or firm might look for in equity for Series A?
That's a Jake question, I think.
Sure, I can take that. The answer is it depends, right? And nobody likes that type of answer, right? The way that we think about Series A, it's not just deal size, but it's also structure, right? Is it structured? Is it priced? Are you giving up a board seat? What are kind of the terms that are involved? Generally speaking, $5 million plus, right? A lot of the Series A's that we're seeing in this space tend to be in kind of the $10 to $20 million range. But again, it varies dramatically based on the sector that you're operating in and what those use of proceeds are. So I'm gonna take a pass on that one and say, go read the State of the Markets report we dropped in the chat. We got some great metrics in there. It'll make it easy for you. But thanks for the tee up there, Jeff.
Thanks,
Okay.
Jake. Next question from Julie. We're an enterprise B2B SaaS and have been doing a bridge round, friends and family, to help with the long sales cycles. We're finding it hard to raise as pre-revenue. What advice can you give?
Yeah, let me take that one. This is an area where you have to obviously be very, very creative. What we found, and we've built our business development and partnerships business around this idea. Oftentimes, the best investors for this type of raise are insiders to the problem. Executives or companies that are partners and have worked in this before and really understand intimately what you're doing. These businesses oftentimes are highly technical and hard to explain to what you might call pedestrian investors. I would try to go as deeply as I could go into people who really live and breathe this problem, strategic partners, executives at firms that know this. Even investment professionals that invest in larger scale businesses that see some promise in your business and may want to make a personal investment in the business is how I'd approach this. But this is a calorie burn exercise, Julie, and you will get through it, but it's going to take a lot of work and a lot of creativity. We can help with a lot of this, and we do help with a lot of this on the strategic side, finding corporate VCs and other strategic partners. It's a lot of work, but when you find it, it's great money because they really understand your business.
I know we're only supposed to do one per question, Benjamin, so I apologize, but I just have one final thought. One thing that we've seen a lot of that earlier in my career, I didn't see really at all was family offices participating in VC rounds, which is sort of an extension of kind of angels and corporate investments, as Jeff was mentioning. But family offices have definitely gotten much more active in earlier stage rounds than they have historically. So it's another source of capital. I mean, there's huge pools of capital sitting in family offices. The process is very different. And what I've seen is that they approach it somewhere between, it's more sophisticated, I would say, than an angel in terms of the diligence that they're doing, but it's not quite at the level of what a fund would or a classic institutional investor would. So that might be if you can tell that story right, that might be another avenue to pursue.
Great. Next question. Can you touch on the seed stage funding environment for B2B SaaS and FinTech? What is the profile and metrics of deals getting done? And that's from Sean Neufer, if I'm pronouncing your name correctly.
So I'll take a swing at that one. I'm going to punt on metrics again. Go read the report because you've got some really, really juicy details in there. But I do want to touch on the B2B SaaS component, which I think is interesting. In a lot of the conversations I've had with VCs over the last 12 months or so, it's a very clear bifurcation of you either have investors, given the regulatory environment, that actually don't want to deploy capital into companies that are quote unquote deep fintech, that require licensure, that are moving money, lending money, holding customer funds, and instead are looking for companies that can deploy pure software-based solutions, SaaS, into verticals, grow as a software company, and then layer in financial services down the road when the business is more mature. It's got more capital that it can deploy into things like KYC, AML, and going and getting money transmission license and things of that nature. And so think about the business that you're building and think about that bifurcation. It's helpful, especially if you are actually in the regulatory sphere and you do require licensure for your business model, that you're having that conversation upfront with investors to understand, is that something that they have appetite for from a model standpoint? On the metric side, I don't know, Chris, Derek, Jeff, anything you guys want to touch on as it relates to seed?
And I think metrics at seed are hard. At seed, really, you want to see the team, the product, the TAM, and how you're addressing it. It's far more qualitative in many ways than quantitative. Just tell the best story you can, and try to bring the story to life in terms of real examples and how big this could be and why you're the right team to prosecute it with the product that you have.
Yeah, I think Jeff's spot on in terms of seed stage. Sorry, Benjamin. I think he's spot on. I do think that there is an opportunity at the seed stage to distinguish yourself from other seed stage companies with a really robust forecasting approach and methodology that basically exhibits the fact that you know your business better than anyone. You know what the drivers are, you know what the pricing levers are, you know where there are new pathways to new channels, which you can, kind of use a financial forecasting tool or model to demonstrate. Most of the seed stage models are weak, they're limited. And so it's really hard, because the metrics aren't there, it's really hard for an investor to understand where you're going. If you can do that really well before you necessarily have to, that will set you apart, because then you can go and tell that story around the forecast and not necessarily have to rely on, the history that you don't have yet.
I want to add one last data point just because it surprised me, and this is kind of counter narrative, if you will, from a lot of the fundraising advice that's out there. What we actually found for fintech companies in this last report are those that in the same cohort were in the top quartile of round size at seed had 2x the graduation rate of being able to successfully go out and raise a Series A. So there's a lot of advice that's out there that says, hey, raise as little money as possible, keep burn as low as possible, wait until you need to go out and dilute yourself. It was interesting for us to see in the data that actually those that were the most well capitalized, despite what that burn rate was, you can still raise a bunch of money and keep burn quite low. If you're disciplined, those well-capitalized businesses graduated and raised a Series A at twice the rate of those that were not in that top quartile.
So your answers have been so engaging. We've gotten a couple more questions. We really need to do this in a lightning round if we want to try and touch on them. But also, I'll let everybody know that afterwards, we are going to share information about the experts here so you can reach out. This question is from Daniel Missioner. If a company is acquiring leverage to lend to its clients on lend, Is it better to set up a SPV to fund the transactions or directly borrow in the company, which will require more equity to meet leverage ratio requirements of the on-lender? And again, if you can keep this to under a minute, we might be able to get through this.
Lightning round. Yeah, I can, Jake, you can do it too. It depends how you want to pay the piper. You know, the all lean kind of venture debt kind of solution that is attaching to the business may require some warrants. It probably has fewer covenants, but it can be very dilutive on the warrant side. The true asset-backed facility is going to require that you have the cash in the bank. It's probably more operationally intensive. So really, it's a question of kind of where you are and what you can afford from both a dilution and ability to raise cash. We're seeing we're seeing some really wonderful term sheets coming out of the venture debt community with very low covenants, reasonable rates, but very high dilutions. And we've got some lenders that work with us for early stage companies on the asset-backed side that give high advances, but require some haircut. It's a high interest rate. So it really is kind of needs something to be modeled and to really understand the effect it has on the business, on the cash burn, and on your ability to kind of get to that next important point.
Yeah. Thank you, Jeff. For payments or POS fintech focused on small businesses, which metric is more important to raise a Series A today? GPV or net revenue? That is X interchange. And what's this magical number? And this comes from Caetano Nobre.
Magic number is tough because it's so contextual, right? Like it depends on your business, your geography, the sector that you're in, etc. But GPV versus net revenue, my personal preference is that I weight net revenue higher because it's a higher quality metric, right? Like you see a lot of businesses that can get a lot of GPV, but it's actually low quality revenue, and it might even be gross margin negative, or when you bake in all the ops costs, it doesn't actually make business sense fundamentally, even though the top line looks really good, right? So it's GPV in my mind is interesting and a nice data point, but the net revenue is really where the action is when it comes to an assessment perspective.
I'm going to take the contrarian view, Derek. I hope we can still be friends.
Sure.
I think at the seed stage, I would actually have said GPV because it gives you a sense for the market, right? It tells you how big of an opportunity this could be. You could be a company that charges nothing for 6 months just to establish market presence. And if you can grow that GPV and show that there's platform revenue that you're going to get some piece of through the interchange fee at some point, at the seed stage, that's the story you're selling. What's the scale of the opportunity? And I think GPV speaks to that. I think Derek's absolutely right. As you get more advanced, and metrics get more sophisticated, net revenue obviously speaks to the health of the company and what share you're going to keep. But earlier on, if you can make some headway on GPV, I think that's great because that means somebody's buying. Right. And that's the signal that you're looking for to see somebody's buying, somebody's happy, and you can keep doing that thing.
I actually agree with all that. It's stage appropriate, right? Like GPV is a product market fit signal. And then later on, we talked in the course of this webinar about, credible financial metrics and understanding your unit economics. And that's where later on the net revenue aspect comes in.
Thank you so much for the panelists and for everyone, these engaging questions. I'm sorry we weren't able to get through all of them. We did get through most. And Jake is going to wrap it up and tell us how we can stay in touch.
Awesome. Well, thank you again, Benjamin. Really well moderated session. Jeff, Derek, Chris, always great to have these types of conversations. I know we've got a bunch more questions in the chat here. And so for folks that are interested in connecting with our panelists today, we're going to be sending up a follow-up email. It's going to include a recording of this session and the contact information for all of our panelists. We'll pull up some disclaimers here quickly. And this is what's going to allow us to actually record this section and get it out the door. But thank you again for those joining us. Have a great rest of your day. For those that are out fundraising, best of luck in your process. And hope to see some interesting folks reaching out after this conversation. Thanks, everyone.
Thank
Bye
you.
now.